Is there any type of concern at all that the supply of companies for sale is going to, especially with an improving economy, maybe, stop or slow down at all?
I think in this environment right now, there's been concern in terms of the perceived quality of some companies, because even stable companies that is generally decent performance in this environment right now have a hard time forecasting where they're going to be over the next 12 months. There's a lot of uncertainty in the marketplace. You've got commodity inflation. You've got demand on the revenue side stagnating a little bit. And so I think there is some uncertainty on the outlooks. If you look across private equity portfolios, I would say there are still a lot of private equity firms that are sellers into this market. And while their outward communication may be, we'd like to wait until the market strengthens or there's more liquidity, I think the honest perspective is we'd be willing to take a little less in this environment than we would have maybe 12 months ago relative to our expectations. And the reason for that is if you can deliver a rate of return or a multiple of capital to your LPs in this environment, it has more inherent value than it does when the markets are strong and there's a lot of liquidity. And you can stand out among private equity firms in that context.
I think people now, sellers are understanding that the type of multiples that they could sell at in 06 and 07 were unprecedented, unrealistic, and probably not going to happen again in the near future. So holding out for that 12 times EBITDA multiple for the next 3 years when you're not going to get it anyhow is only going to hurt your returns to your limited partners. So if you're only going to get 8.5 and you're only going to get 8.5 next year and there's some uncertainty in the economy, why not sell today? Because your IRR is going to probably be much higher today than it is in a year or two.
And people have had 9 months, 10 months to digest the turmoil that has been in the marketplace starting last summer. And now people are beginning to get back to, okay, it's time to do something with our portfolio, and there are some assets that need to be moved out of our portfolio. So people are, while they may have delayed processes, during the last 6 month period, I think people are starting to put them back on the table again.
I think, just the point on people's outlook, and I haven't heard many people today express that there's going to be a big rebound in the economy. So when you look across your portfolio and you're looking at it, stability, possibly slow growth, or heading into further a deepening recession, the prospect when you're managing a portfolio says if you've got assets that are performing and to your point, that 2 years down the road, they may be performing maybe, if you're lucky, 10% better than where you are right now. If you can get out today and enhance what we're measured on, which is IRR, that's the rational choice. The flip side of that is for high quality companies that have demonstrated growth through this environment, and that growth, I think, probably can come mostly through share gain. There is a lot of value and high multiples that can be achieved in this environment for those types of businesses, because there's a lot of capital sitting on the sidelines that is waiting for those types of opportunities, and they will pay for the right quality company. It's just the private equity firms are going to absorb what the credit markets won't right now.